Welcome to the PAI Morning Briefing. I'm your host from Pantheon AI, and today is March 12th, 2025. Good morning, everyone. I hope you're all doing well and that your coffee's as hot as the markets this morning, even if the numbers seem a bit chilly. Today, we're going to break down the latest developments across the financial spectrum, from the main indexes down to the buzzworthy tech headlines, and we'll even dig into some global trends that might just change your trading game. So grab your notepad and let's jump right in.
Let's start with a quick market overview. The major indexes had a rather mixed day yesterday. The S&P 500 closed at approximately 5,579, down nearly 0.81%. Not a dramatic move, but a subtle reminder that even the blue chips have their off days. The Dow Jones, which many of us treat as a barometer for overall market sentiment, ended at around 41,158, experiencing a decline of about 1%. In the tech-heavy Nasdaq, the picture was comparable, with a close near 17,583. That represented a loss of roughly 0.7% for the day. Meanwhile, the Russell 2000, an index that often captures the performance of our smaller cap companies, settled at about 2,023, and it too slipped by around 0.7%.
Turning our attention to the cryptocurrency market, a world whose highs and lows can give even the most seasoned trader a mini heart attack, Bitcoin was trading at approximately $81,626, down around 1.54%. Ethereum wasn't far behind in its descent, with its price coming in near $1,861, marking a more pronounced fall of around 3.18%. It seems like the digital currencies are following a similar cautionary tale as the broader stock market, prompting investors to reassess their exposure as volatility persists.
Now let's move on to a deep dive into some major market trends that we've been tracking over the past few days. It's no secret that the global market sentiment has been swinging like a pendulum recently. On one hand, we're hearing encouraging signs on the technology front. On the other hand, broader geopolitical uncertainties and shifts in policy are adding layers of complexity. The performance of major indexes, even while marginally down, suggests that investors are waiting for a catalyst, a spark to ignite growth. But that spark is proving elusive for now.
Take, for example, the recent chatter in the semiconductor space. There's been a lot of buzz surrounding Intel and its potential rescue plan. According to Reuters, TSMC has reportedly reached out to major industry players, including Nvidia and Broadcom, to explore a joint venture that could potentially take the reins of Intel's manufacturing operations. This isn't just industry gossip, it's a clear signal that even stalwart companies are looking for innovative ways to reinvent themselves in the face of rising global competition. Early indications point to the fact that such a proposal, while innovative, would likely run into significant hurdles. Regulatory challenges, integration headaches, and even the sheer inertia of change in such a massive operation are all real issues that could delay or derail the project. Yet, if this collaboration, if it eventually comes to fruition, can overcome these obstacles, it might serve as a bellwether for future partnerships in the semiconductor industry.
We could be seeing the very early stages of a broader industry consolidation or even a redefinition of how these companies work together.
Jumping over to the robotics sector, a company that many of you may have seen in your living rooms or offices with its humble little Roomba, iRobot, has been facing some very serious headwinds lately. Repeated reports from various outlets, including multiple segments from the same Reuters story, have warned that iRobot might be facing existential risks. The company has even stated there's substantial doubt about its ability to continue operating if conditions don't change. This kind of news isn't just a blip, it sends shockwaves through the market, especially among investors who have built their confidence around innovation in automation. It's a stark reminder that even companies once viewed as pioneers in their field are not immune to market pressures. And while a 36% drop in the stock is alarming, it does highlight a broader trend. The market is becoming less forgiving of companies that fail to adapt quickly enough to rapidly changing technologies and consumer expectations.
And speaking of adaptation, let's turn our attention to the gaming sector, a sphere that continues to surprise even the most ardent market watchers. We've recently learned that Niantic, the studio behind the global phenomenon Pokémon Go, has been sold to Scopely for approximately $3.5 billion. For those of you who appreciate the evolution of tech companies, this story is not just about money changing hands, it's about strategic repositioning within an industry that's more competitive than ever. Niantic has shown how innovation in augmented reality can create new revenue streams, and while some may wonder if this marks the end of an era for the company, others see it as the opportunity for reinvention under a new banner. It raises interesting questions about the future of mobile gaming and how legacy companies might bridge the gap between nostalgia and next-generation technology.
Heading over to the aerospace and travel sectors, there's buzz surrounding Boeing. Reports indicate that due to escalating tariffs, the cost of Boeing planes could see dramatic increases by millions of dollars, according to comments made by AerCap's CEO Angus Kelly on CNBC's Squawk Box. Given Boeing's pivotal role not only in aviation but also in the global supply chain for aerospace components, any hint of price inflation can have sweeping consequences for airlines and manufacturers alike. This is a situation where a seemingly localized issue, a tariff, might snowball into a broader economic challenge, especially if airline companies already reeling from what one analyst dubbed a parade of horribles in Q1 performance decide to cut back on orders or pass increased costs onto their passengers.
For airlines already operating on razor-thin margins, an additional multi-million-dollar surcharge on aircraft isn't just a line item. It could signal deeper operational issues that might ripple out across the global travel ecosystem.
Then there's the turbulence in airline profits. Analysts from TD Cowen have been vocal about the volatility expected to persist in airline stocks. Coupled with the headwinds from rising fuel costs and the potential for increased tariffs on aircraft, this industry appears to be in the midst of a real reckoning. The travel and leisure sectors, always sensitive to changes in both economic sentiment and policy measures, have been grappling with uncertainty since the start of the year, and it doesn't seem like clear skies are on the immediate horizon. Investors entrenched in this field might need to brace themselves for more bumps in the road and consider whether defensive positions or diversifications into related sectors might be the best strategy moving forward.
While these individual stories are making headlines, they all are interconnected by a single thread: the undeniable pressure on companies to innovate, streamline operations, and adapt to both disruptive technologies and shifting external forces. In the semiconductor world, we're looking at potential structural changes that could redefine market dynamics for decades. In robotics, we see a cautionary tale of a once steady performers grappling with disruptive market conditions. And in aerospace and airlines, industry giants are now navigating the intricacies of global trade policies that could reshape how business is done on an international scale.
Now, let's dive deeper into our comprehensive coverage of the most important stories making the rounds today, 10 distinct pieces if you include each angle of repeated coverage.
Our first major story today concerns Intel stock, which has been climbing steadily. But what's driving that surge? Reuters has reported that TSMC, the world's leading semiconductor foundry, has initiated conversations with heavyweights such as Nvidia and Broadcom about a joint venture designed to take over the operations of Intel's factories. It's an audacious proposition that suggests neither company is content with the status quo. Intel, a name that has come to symbolize decades of innovation in chip manufacturing, may be at a crossroads. The idea of a consortium of industry giants running its manufacturing facilities signals both an acknowledgement of past missteps and an aggressive move toward a collaborative future. The potential benefits are enormous, a chance to leverage complementary strengths, but the road ahead is likely to be fraught with regulatory questions, cultural challenges, and integration complexities.
Could this be the revitalization that Intel needs, or are we simply witnessing a temporary band-aid on a deep-seated industry issue?
Our second piece of news is essentially a reiteration of the Intel rescue plan, an echo of the first story that underscores its importance to investors. The fact that multiple reports are stressing the same potential for a joint venture indicates that, regardless of the hurdles, there's significant market sentiment riding on this development. Market participants are watching closely to see if this bold proposition will trigger further confidence in the sector or whether it will eventually fizzle out under the weight of its own complexity. It reminds me of a classic tale: sometimes when you have too many cooks in the kitchen, the meal ends up under-seasoned rather than a home-cooked masterpiece.
Moving on, we have not one but 3 separate reports addressing the challenges facing iRobot. The maker of that reliable little Roomba is sending shockwaves through the market with warnings that it may be on the brink of collapse. Investors are now staring down a potential downturn that includes a staggering 36% decline in its stock price. This repeated coverage isn't just redundant journalism, it reflects the deep concern held by multiple market analysts regarding the company's long-term viability. The robotics revolution was once heralded as unstoppable, yet here we are, confronted with a stark reminder that even iconic brands can falter if they fail to keep pace with technological innovation and market demands. In a way, it's almost poetic. A company once celebrated for its smart home devices now finds itself in need of a rescue of its own.
One can't help but wonder what tactical missteps led to this predicament and whether this is a sign of broader issues in the robotics industry as a whole.
Our next story takes us to the gaming world, where Niantic, the creative force behind Pokémon Go, has been sold to Scopely for approximately $3.5 billion. This transaction is more than just a massive capital move. It's a strategic repositioning for a company that's been riding the wave of augmented reality and mobile gaming for several years now. For many investors, Niantic's journey has been one of highs and lows, and this sale signals a new chapter. While the summary details are sparse, the sheer magnitude of the deal speaks volumes about the increasing value placed on immersive mobile experiences and the monetization of digital communities. It begs the question, if gaming companies can command such power in the market, what does this mean for the future direction of entertainment and virtual engagement?
In our fifth story, we turn our attention back to aerospace, focusing on Boeing. The narrative here is that Boeing could see plane prices increase by millions as a result of tariffs, an insight shared by AerCap's CEO Angus Kelly during his discussion on CNBC's Squawk Box. The implications of this are no small matter. In an industry where profit margins are already razor-thin, a substantial price hike not only affects Boeing but also reverberates through the entire supply chain, from the competitive bidding processes of airlines to the negotiation tables of manufacturers. It's a domino effect that forces many to consider, when external pressures such as tariffs come into play, who really absorbs the cost? The answer might unfold over the next few months, and investors would do well to keep a close eye on this developing narrative.
Our sixth story, essentially a reflection of the fifth, reiterates Boeing's looming challenges with tariffs. This duplication in the news cycle underscores just how serious the issue is perceived to be. Once again, the focus is squarely on understanding the full impact of global trade policies on domestic manufacturing giants. It's a critical moment for Boeing, whose performance could very well reflect larger economic trends. With multiple analysts echoing these concerns, it's clear that investors are not taking this lightly.
Story number 7 again hones in on the Boeing tariff issue, a third echo that further cements the narrative. With tariffs becoming an everyday part of the global trade lexicon, the aerospace industry is facing a reckoning. The question remains, will Boeing be able to negotiate these choppy waters, or will these external pressures finally force them to reevaluate their long-held pricing strategies? It's a topic that has everyone from Wall Street strategists to industry insiders scrutinizing every decimal point in the quarterly earnings reports.
Our eighth story shifts back to airlines as a whole. Recent analysis from TD Cowen has put forth a stark warning regarding airline profits, which appear to be in for a difficult ride. Dubbed by some as a parade of horribles occurring in the first quarter, the airline industry is clearly still reeling from several headwinds. Whether it's the volatility in fuel prices, increased competition, or the lingering aftershocks of recent economic policies, the message is consistent. The road ahead for airlines will be anything but smooth. For investors, this serves as a reminder to maintain a well-balanced portfolio, especially if you have heavy exposure to this sector.
And finally, our 10th story, which again revisits the turbulent state of airline profits. With repetitive reports emphasizing the volatility and challenges within this sector, it's a recurring theme that demands our attention. As airlines navigate through a series of operational and financial headwinds, the industry may see more consolidation or perhaps a strategic pivot toward more resilient business models. The key question for investors remains, how long can these companies withstand the turbulence? And what does this mean for the broader travel and leisure economy?
Having covered a spectrum of stories from semiconductors to robotics, gaming to airlines, let's now shift into a detailed sector analysis. Today, the tech sector is once again proving to be a double-edged sword. On one side, the proposed collaboration around Intel's manufacturing signal innovation and cross-industry cooperation, a trend that suggests a more interconnected future for chip makers. On the other, the repeated negative reporting on companies like iRobot exposes the harsh realities of innovation where failing to swiftly adapt can lead to dire consequences. Investors in the tech space might want to consider diversifying their holdings, balancing out high-risk, high-reward ventures with more established names that show resilience in the face of stiff competition.
The repercussions in the aerospace and aviation sectors are noteworthy as well. The looming tariffs on Boeing's aircraft are more than just numbers on a balance sheet. They are a harbinger of change. Tariffs, after all, are a tool of policy, a way to either protect domestic industries or to levitate global tension, and they have a way of reminding us that even the giants of industry can be vulnerable to external forces. For airline investors, the current climate calls for careful risk management. With profit margins being squeezed tighter by rising operational costs and the unpredictable nature of global trade disputes, it could be enlightening to review exposure levels and reassess the risk-reward balance in these sectors. Humor me, if you will. Sometimes managing an airline portfolio feels like trying to keep a handful of helium balloons from floating away during a windy day. It's all about balance and knowing when to let one go.
Turning our gaze toward global market implications, these sectoral challenges underscore the increasing interconnectedness of our world's financial systems. A tariff imposed on one product can have ripple effects across continents, while a tech innovation on one side of the globe may redefine market standards here at home. The proposed joint venture to manage Intel's factories, for example, isn't solely a domestic play. Its successful execution or outright failure could send ripples throughout the entire technology supply chain spanning from Asia to the Americas. Similarly, the price hikes for Boeing planes, spurred by tariffs, bring to light the inherent risks involving global supply chains, trade policies, and currency fluctuations that investors need to understand better than ever before.
Expert analysis from seasoned strategists suggests that we might be witnessing the early sparks of a new era in which collaboration becomes the norm rather than the exception. If companies can learn to work together, blending their strengths and resources while sharing the burden of risk, then perhaps we'll find an alternative path to growth that bypasses some of the volatility we've experienced recently. However, such optimism is tempered by the reality that integration on such a large scale is never straightforward. The road to progress is littered with regulatory hurdles, cultural differences, and the occasional bout of bureaucratic red tape. It will be fascinating to see how these conflicts play out in the coming quarters.
Looking ahead, predictions in the market remain cautious yet hopeful. Some analysts expect that despite short-term volatility, we could be on the cusp of a gradual recovery. There are early signals in various economic data points that suggest liquidity is slowly returning to the broader market. However, investors must remain nimble. The fluctuations in the cryptocurrency zone, for example, remind us that traditional and digital assets are locked into a complex dance influenced by sentiment, regulatory shifts, and sometimes even a tweet or two. Meanwhile, in the aerospace and travel sectors, the coming months may see concerted efforts at cost management as companies pivot in response to external pressures. The big question remains, will these adjustments lead to sustainable improvements, or are we looking at a temporary patch-up measure in the face of a more persistent downturn?
Let's pause for a moment and inject a little humor into our conversation because, let's face it, sometimes the financial markets can seem as unpredictable as a cat on a hot tin roof. I like to joke that the only thing more volatile in market sentiment is my morning coffee. It sometimes gives you a kick you never saw coming and leaves you reeling for a bit. And if your portfolio ever starts feeling like it's been on a roller coaster, just remember, even the steepest drops are often followed by climbs. But of course, safety belts are recommended for both roller coaster rides and investment strategies.
Before we wrap up today's in-depth briefing, let's consider some thought-provoking questions. What does the potential joint venture in semiconductor manufacturing mean for the future of legacy tech companies? Could this be a blueprint for future collaborations in highly competitive sectors? Or is it simply a desperate attempt by an industry giant to stay relevant? Similarly, as we witness dramatic shifts in industries like robotics and aerospace, how should we, as investors, recalibrate our portfolios to hedge against these risks without sacrificing potential gains? And in today's hyper-connected world where one friend's social media rant can sometimes trigger a market sell-off, how do we build a strategy that's resilient to both macroeconomic changes and micro-level sentiment swings?
To sum up, today's episode has been a whirlwind tour across major indexes, deep dives into hot market trends, and a comprehensive exploration of the stories shaping various sectors, from Intel's ambitious turnaround strategy and iRobot's stark warnings to Niantic's strategic sale, Boeing's tariff-induced challenges, and the persistent turbulence in the airline industry. Each story, while seemingly isolated, fits into the broader mosaic of a market and flex one that is as intricate as it is dynamic.
Key takeaways for our investors and traders this morning are clear. Diversification remains critical. Keeping a keen eye on emerging collaborations can offer fresh opportunities. And finally, maintaining a balanced portfolio that can absorb shocks from regulatory changes or global trade disputes is more essential than ever. It's a tough landscape out there, but with informed analysis and cautious strategy, even market uncertainty can be turned into an opportunity.
Thank you for joining me on this journey through today's financial news. I want to give a special shout out to Pantheon AI, your information co-pilot in navigating these complex market trends. As always, I invite you to share your own thoughts, ask questions, and engage with our AI co-pilot because learning shouldn't feel like a full-time job.
As we close out today's episode, reflect on these ideas and questions, and think about how each unfolding narrative might intersect with your own investment strategy. I look forward to having you back with us tomorrow for more insights, fresh perspectives, and of course, a few more moments of market humor. Until then, keep your strategies sharp and your perspectives broad. And remember, even when the market is a wild ride, we're here to help you navigate every twist and turn.
Take care, stay curious, and never hesitate to ask that question that might just change the way you look at the world of finance. Have a great day, everyone, and see you tomorrow. Learning shouldn't feel like a full-time job.